Welcome to the Cherry Bekaert Tax Beat, a conversation about tax that matters.
Welcome to the Cherry Bekaert Tax Beat podcast. Today we're looking at the evolving world of pass-through entity tax programs of various states. New laws in at least 20 states are driving partnerships, S corporations, and trusts to revisit their understanding and consider new opportunities for state income taxes and the related deductions. All right, joining us today on this podcast are several colleagues. First, from our state and local tax team, Cathie.
Hello there. My name is Cathie Stanton, and I lead the state and local tax practice for Cherry Bekaert, and I sit in the greater Washington, D.C. area.
Tony.
Thanks, Brooks. My name is Tony Konkol. I'm a manager in the state and local income franchise practice at Cherry Bekaert, and I sit in the Charlotte, North Carolina office.
And as always, Sarah.
Hello, this is Sarah McGregor. I work in the federal tax area, and I am in lovely Greenville, South Carolina.
And I'm Brooks Nelson, partner, sitting in Richmond, Virginia today. All right, so Sarah McGregor, how's life treating you?
Life is always as good, Brooks. We are past October 15 tax filing, so almost all 2020 returns have now been prepared and processed. So our teams can finally start thinking in terms of 2021 being the current tax year. We're always a little bit delayed thinking the current year is the one we're preparing. And so now we could be thinking about 2021 and what's happening next. But the weather is excellent. I get to go home at night without my lights on the car turned on. And so it's a good thing.
And your football team won an SEC game this past weekend.
Yes, they did. Thank goodness for Vandy.
Hey, now, well, yeah, I'm a contributing parent to the Vanderbilt football program, so I'm not so sure about that. But anyway, it was an exciting game. All right, so let's move on to today's topic, and let's begin with a little background about why this topic has so much relevance, why it's getting so much attention. In December 2017, then President Trump signed into law the signature tax reform bill, the Tax Cuts and Jobs Act, TCJA. You'll hear it referred to any of those three things. One of the key provisions in that signature, really one of his signature legislative moments, was limiting the deduction for state and local taxes on your individual federal income tax returns to $10,000. So that's just not for your income taxes. That's for your real estate taxes and your property taxes. $10,000 combined for everything. For a joint taxpayer, that's not too difficult to get up to that $10,000 limit. It was particularly, or at least it feels particularly punitive to taxpayers in high income tax states, or I should say states with high state income tax rates, and it felt punitive to people who are members of a pass-through entity, the LLCs, the partnerships, the S corps, and trusts that have beneficiaries handing out K-1s. So particularly in the business context, as a C corp, the corporation is paying those state taxes, so you didn't really feel it there, but pass-through entities in business pay the income taxes typically or generally at the federal, for federal and state at the individual level, reporting that income on your 1040 return. So there felt like, for many people, a lot of inequity, based on just the form of entity that your business was conducting in for tax purposes. And again, there's also a sense of inequity between high state rate states and low state rate states. So I would say that's kind of the background story for the drama. And there is a lot of drama in this area, I would say. So, Cathie, entree, the SALT expert here, how have the states and taxpayers responded in general to this SALT cap?
Yeah, that's a great question. It's been very interesting in the state tax world. Certainly the Democratic states felt this was a personal attack by the Trump administration on their states, being that some of the Democrat states or Democrat leading states do have the higher state income tax rate. So they saw that as an attack. And so immediately the state started looking at workarounds. What can we do to get our constituents back to the same place prior to that limitation being put in place? So one of the first things that the states looked at, there are certain funds that states have used, certainly around the education area, where within a state, if you're an individual in that state, you can make a contribution to that state fund. And that state then will allow you a credit for the amount of tax or amount of contribution or a percentage of the contribution on the state income tax return. And the IRS has actually sanctioned this strategy in previous private letter rulings that they could get a charitable contribution for that donation. So it really was kind of like double dipping that was permissible. And it was really to benefit education a lot of times. So the states immediately looked at that technique. Can we set up these funds and contribute something to the fund, and then you can get a credit and then still get the charitable contribution deduction? So that was the first thing. And the IRS certainly replied pretty quickly that no, you cannot get a charitable deduction if you're getting something in return. So that was one way the states were trying to look at that. The second way is, there are a number of states that impose tax at the pass-through entity level. DC is one of those states, Tennessee is one of those states, and that tax is imposed at the entity level. The entity, when filing an income tax return, would deduct that tax against that ordinary income, and taxpayers would get the benefit for that. And so even with the SALT cap, taxpayers would still get the benefit of that deduction at the individual level indirectly. So this pass-through entity election is basically following that Tennessee or DC approach. Let's impose tax at the pass-through entity level to make this deductible instead of flowing through to the individual level. And that was the birth of the pass-through entity election.
So really that was to help sort of level the playing field between businesses that like C corporations who are paying tax in the state and can deduct it, and those pass-through entities where the individuals were paying the tax but could no longer deduct those taxes, to try to get it back to a common playing field for at least the business related taxes. But Cathie, that notice that came out quickly dealing with the charitable contributions, that really hurt some of those existing programs that were doing some good in the states.
Yeah, it sure did. In fact, I had some discussions with attorneys that were involved in setting up those programs, and some of the southern states relied heavily on that for their education funding. I think there was some guidance that corporations could still, in certain circumstances, contribute to those funds and get a benefit, but yes, that was not a good answer for the states that were using those funds, for sure.
Well, let's just be clear for our listeners. It didn't say you absolutely could not do it. It just basically said you had to reduce the amount of your deduction for charitable purposes by the amount of the credit. And so it just reduced the attractiveness of it that previously was there. And they did put a 15% value de minimis rule in there too. So some programs are still able to sneak in under that part of it.
Sure.
Nonetheless, very unfavorable for taxpayers.
Yeah.
All right. So Tony, more recent IRS guidance, specifically notice 2020-75 is more favorable. So share your thoughts on that.
Well, Brooks, I don't know if this is the IRS saying they look favorably upon these entity level pass-through taxes, but at least they're saying we'll tolerate it. So this came out on November 9th, 2020, and what it says is partnership or S corporation can, in computing its non-separately stated taxable income or loss, can deduct state and local taxes imposed on its net income for the tax year. So this notice said that the IRS is going to be proposing regulations for the mechanics of how a pass-through entity can take the deduction for state and local taxes. However, we're on the home stretch of almost a year now since this notice came out, and we still don't have any further guidance yet or any of the proposed regulations.
So I'm guessing there were a number of problems that have popped up as they started to think about how to practically apply this. But Tony, it's not been, the states have approached the pass-through entity level taxation in different ways. What are you seeing there and some sort of trends?
Well, since this notice came out, there's been a noticeable uptick in legislation for pass-through entity level taxes. Before this, before the notice came out, there were about 7 states the same time last year that had something like this in place, and now we have 20 just a year later. So for some of these states, some will go into effect in 2021, some will go into effect 2022, but at least right now there are 20 states that have something ready to go, and another 3 with something in their state legislatures right now that will probably pass in some form or another. But as Cathie mentioned, this isn't a new concept either. So we're seeing a lot more of this activity, but it's not a new idea either. DC, New York City, New Hampshire, Tennessee. Yeah, we're just seeing a lot more of it now. In terms of trends, Connecticut was the first state to pass something like this in 2018. They're the first state that came out with this, and they said it wasn't an optional election; it was it was mandatory. You didn't have a choice. Every state since then has made it an optional election. So, that's one thing where you can see that may not have really caught on. And it seems to be the way going forward that most states will probably stick with some kind of elective mechanism for doing this.
Yeah. And Cathie, kind of the distinction between Tennessee and say Georgia right next door, Georgia has an individual level tax, but Tennessee really doesn't tax a lot of earned income. So a pass-through entity level tax approach in one state or the other can have a very different impact depending on where the owners are.
Yes, absolutely. There are a lot of things to consider with the pass-through entity elections. And that you hit on one, depending on where the owners are. So each state that's enacted legislation, unfortunately, no one's adopted like a consistent model. All of them are different. So that's always, in the state and local tax world, we have complexity because of all the different statutes and regulations, and there's no difference here on the pass-through entity election level either. So some of the considerations that we have to take into account, number one, is the pass-through entity eligible to make the election? There are different eligibility requirements. In some states, you have to have only individuals own the pass-through entity. Other states, you can have tiered pass-through entities. You could have, other types of owners. But one of the most important aspects, or one of the most difficult issues that we've been dealing with, is where those owners reside. Because in order for the pass-through entity election to work, to turn this SALT cap of 10,000 max deduction on an individual return to being able to deduct all your tax applicable to the pass-through entity's business income, in order for that to work, you have to provide a credit for the individual. If you're going to impose the tax at the entity level, for federal tax purposes, that income is still in that individual's adjusted gross income. States start with adjusted gross income. So their state taxable income is going to include all of that income. So the state needs to allow a credit for the taxes paid at the pass-through entity level in order for this to work. I will say there's always exceptions. Some states may allow a deduction of the income instead, but generally, for the most part, for example, I sit in Maryland, sitting in Maryland right now. Maryland has enacted the pass-through entity election. So any pass-through entity in the state of Maryland can make that election, impose a tax at the entity level. So then when the resident, say it's a Maryland resident, files their individual tax return, all that income is in their individual tax return, but then they get a credit for that tax paid at the entity level. If they didn't get that, they would be taxed twice. They'd be taxed at the pass-through entity level, then again at the individual level. So you get a credit mechanism to eliminate that double tax. Where the problem comes in is, in the greater DC area, you have DC residents and Virginia residents. Also, it's all very close together. in DC and Virginia, what if you have residents in those jurisdictions that are an owner in the Maryland pass-through entity? So in those jurisdictions, you have to look. So the Virginia resident, can they get a credit for the tax paid at the entity level? If they don't get a credit, they are double taxed, and no federal deduction of the tax is going to make up for that. You're going to pay double tax. So it would be harmful to make the election if the owners are in a state that do not provide some mechanism to take into account the tax paid at the entity level. So we're really seeing that be an issue, and especially Virginia, DC, they don't like it. Virginia has not wanted to give any guidance. There has been a ruling request submitted. Hopefully we'll get guidance on whether that's allowed or not. DC as well, it's very up in the air. So in the case of Maryland, it appears that the election may be revocable. You may be able to file an amended return to change that. So if we get a really bad result in Virginia or DC, we may be able to make it all right, by filing an amended return on doing the election. But many states, it's an irrevocable election. So if you make that election and you're not quite sure how these states are going to treat it, you might get into some significant trouble. And I'll just, while I'm on this topic, let me talk about some of the other issues that have come up that people really have to consider. Conflicts of interest. Pass-through entities will have, many pass-through entities will have lots of different owners, and owners residing in a lot of different states. Well, it may be very beneficial for some owners and harmful for other owners. So now you have some owners of pass-through entity wanting the election, some owners not wanting the election. So you have a conflict there. Who is authorized at the partnership level to make that election? And you need to revise your partnership agreement to make clear who's authorized to make that election or determine whether that election should be made. And so there are a lot of nuances and considerations to take into account. It would be great if the states, and hopefully more of the states, will provide guidance on the resident credit aspect to give us some clarity in that area.
So, let's just kind of recap some of the reasons why we wouldn't want to make this election. So, one is the resident state doesn't allow a credit, either for your resident tax or for your non-resident tax. So that's a big one. This conflict of interest you're talking about. I would offer, what happens if the $10,000 cap, gets repealed, revoked, although we haven't seen any of that floating around so far. There's certainly a lot of background noise about that, and that would make a lot of this, for the most part, go away, and some of those irrevocable elections wouldn't feel so good at that point. And I would also offer complexity, because we got different states doing different things, and just listening to it, it just sounds so complicated, just on the surface. And obviously, we will deal with complexity if there's a lot of money to be saved, of course. But if you're talking about relatively small amounts of money, I'm not so sure how much you want to do it. What else? Is that pretty much the? Yeah,
and I would say another area that you do not want to miss taking a look at this is if you're selling your business, and that business is structured so that on the federal tax return it's an asset sale. Generally, we see significant income in a year of sale attributable to goodwill and other intangible assets. And so you're absolutely right. The more income you have that's sourced to a state that offers this election, the more you need to look at it. And if you sell your business and there's a huge gain on sale, you absolutely need to look at that, because we're talking about, a federal tax deduction at the federal tax rates, not a state tax, issue that's only at the state rate. This is a federal tax rate, so significant benefits available.
All right, so let's take off our SALT glasses here for a second. And SALT, just to make sure we've said that, SALT stands for state and local tax as an industry acronym. But let's take off the SALT glasses, the lenses. And Sarah, from a federal perspective, what are the issues you need to consider, particularly, as a S corporate partnership when you're making one of these elections?
Well, particularly for an S corporation, where there is a disparity between a shareholder who is resident or non-resident getting benefit of the credit and another shareholder who doesn't get benefit of a credit. Now the question is, well, does that create a different kind of distribution or an inequity in the distributions? It's not on a per share per day or on all shares of stock held on a particular day are given the same distribution rights. And that could really challenge whether the S corporation continues as an S corporation. So that's one area that definitely we would like to get some additional guidance saying that that's not going to create a problem. That's usually cleared up when there are the composite tax returns or withholding. Those resident shareholders who are not subject to composite tax returns or withholding will get an additional distribution. But in this case, it's not really a distribution, it's a deduction in the tax return itself. So that brings up some questions. In the same way with partnerships and other pass-through entities, you're dealing with something that may be a distribution. You've got waterfall distribution and income rights going on in partnerships. Where does this fall? How are partners being treated differently in that respect? And does that create a problem for under the partnership agreement? And as you mentioned, who's making that election? And we have the new partnership audit rules. So if the state is tagging along, that's going to put the partnership representative in charge of any sort of audit findings or assessments there, and where that could come out. What if this deduction is disallowed later down the road? Some lot of different considerations that come into play, but boy, it sure is nice to get a federal tax deduction in full for these payments that are going to have to be made by somebody out of there. So Tony, thinking about this, since these are elections, what are some of the mechanics that need to be followed? Is this something that's just done with the tax return? Does it have to be done before year end, or what's some thoughts on that?
Well, with the states that are doing this, each one has its own unique quirks, in particular set of rules to follow. Generally, what we're seeing is one of two methodologies for the election. It would either be that the entity pays the tax and a credit goes to the member shareholder, or the member shareholder does not get a credit, but their individual tax is reduced by the amount of income that the tax is paid at the entity level. Of the states that have done this, it tends to be more states are following the credit methodology. I think only about 5 have kind of stuck to this idea of the member shareholders' income is reduced by the tax paid at the entity level. As far as requirements go, this is where things can get kind of complicated, especially in first years. There's a lot of deadlines to keep in mind. New York is a state very recently where for the 2021 tax year, the election had to be made by 10/15, but going forward, that election needs to be renewed every year by 3/15. Some states, the election is just done on the return itself. So you have to keep in mind regular and extended due dates, and especially for some of these first years where they're catching things up to speed, where there might be a special date for a certain state to keep in mind, like New York did. That being said, tracking could be a bit of an issue for large multi-state partnerships. If you have elections in a lot of these states, trying to remember to make your elections on time, could be tricky to keep track of these. Also, with estimated payments, this is another issue too, especially in first years where, like with New York, you weren't required to make payments for 2021, but for a lot of individual members or shareholders, they may have already made estimated payments for the year. So in order to get this deduction, well, the entity has to pay some tax, right? So until the individual actually flushes itself out and the individual returns are actually filed for the year, they're in some of these cases for a first year, you may have paid twice as much tax in to get this benefit. It'll come back eventually, but there's a little bit of a waiting period there until returns are actually filed. Some of the limitations we're seeing is that once the elections are made, they are irrevocable for a lot of states. An interesting one now, Michigan has not passed legislation yet, although they have a bill that recently passed their state house and is expected to probably pass soon. This is an interesting one where not only is the election irrevocable for the tax year, but it's also binding on the next 2 tax years after it. So things to keep in mind too. What if there are additional partners, or the capital structure changes for the business? You could have a new partner come in who's kind of locked into an election for another year or two. For depending on the state too, not all members may be eligible. I keep bringing up in New York, but this is one where generally it's individuals and trusts that the election is applicable to. A partnership or S corporation can still make the election. It's just as if the non-eligible partners, shareholders, are just kind of carved out of it. For some of these elections too, you have to look at the tax rates, especially for states that may not have a flat income tax rate. California is a state where they have marginal tax brackets that could run, depending on the amount of income sourced to the state for a non-resident, 1 to 12.3%. But for the entity making the election, it's a flat 9.3%. New York, pretty similarly, 4 to almost 11%, but the for the entity making the election, it starts at 6.85% and goes up to 10.9%. So some of those lower marginal brackets are carved out. So the entity making the election is, maybe the state splits the difference between some of these tax brackets, but they might be paying at a higher rate. Credits, as Cathie mentioned, this is definitely an area of concern where, especially for states that aren't doing this, or aren't going to have some kind of legislation in place for these entity level elections for the tax year. What are they going to do for their residents? Are their residents going to be able to take a credit for taxes paid to other states? Even for states that have pushed through this legislation, in the last couple of years, the last year recently, I feel like this is an issue that kind of was overlooked a little bit in a rush to get these bills through. The idea of, are we going to play nice with other states for the credit for taxes paid to other states for our residents? We have to wait on guidance for that.
Yeah, and the state of Maine decided, no, we're not going to play nice. We're not going to give a credit for the Connecticut pass-through entity tax, and it's mandatory in Connecticut. So we have some states actually aggressively saying, nope, not going to do that.
And what if you're already locked into an election? There you go.
Yeah.
Great.
All right.
I think one other issue too. Some of the states too, the credit may not always be a full credit. Connecticut, Massachusetts very recently too. The credit 90% of the tax paid.
So you're not even you're paying, the entity is paying tax fully, but the credit is not equal to the tax. It's 90% of the tax paid or 80% of the tax paid or something along those lines. Is that, wow.
Yeah, it's a great way to raise revenue. All you have to do is change the credit amount. That's all you have to do is to change your revenue. Yeah, that's true. It's usually not 80, it's still 90 something, but yes, that's true.
All right. So Cathie, all individuals, virtually every pass-through business, maybe a few exceptions, but the vast majority pass-through businesses are in the fourth quarter looking at year-end planning. So what is your sage advice? What direction should we be giving for pass-through entities to consider now?
Yeah, what you want to do first thing is find out how much, or estimate how much state taxable income you're going to have in the various states. You want to provide that, or you want to prepare that estimate, and then look at the states where you have significant, but at least some state taxable income. Look at those states to see whether they have a pass-through entity election or not. If you're eligible to make it, when it's effective, want to look at all the nuances of it to determine whether it would make sense. Because you do need to pay, as Tony mentioned, you have to pay the tax by the entity itself has to pay the tax. So you would not want the individuals making an estimated tax payment for the fourth quarter. You would want the entity making the tax payment in order to get that deduction. So again, you might have some timing issues. But if you're profitable, selling the company, any large amount of income or moderate amount of income in any of these states that have these elections, you want to analyze them now.
All righty. So Sarah, you have any other final comments or thoughts on today's topic?
Well, it sounds like as always, it's going to be complicated, and each business and individuals who are owners of pass-through entities are going to have to look at the states, look at the rules, and see which one is the most optimum. With a reminder that this only runs till the end of into 2025 anyway, and could all expire and leave these pass-through entity level taxes just for another couple of years.
Yeah, and Sarah, I would add to that, though, maybe there's some benefit beyond that if they're still in place, if it circumvents the alt-min tax, because you wouldn't necessarily have to add back that tax. So there might be some benefit beyond that as well. But certainly, one thing I want to get across, these benefits could be substantial. So you want to analyze it because the benefits could be very substantial.
Yeah, you're talking about going from zero deduction at 37 or as high as 39.6, depending on what may happen with the tax laws, versus every dollar of tax is above that 10,000 is going to get you 40 cents or so back in savings.
That's right.
Right. I think that is a great concluding comment. So, all right, listeners, thank you for tuning in today for our discussion on the $10,000 SALT cap workaround for pass-through entities. A quick disclaimer that we are not providing tax advice on this podcast. Please consult with your tax advisor, hopefully at Cherry Bekaert, with your specific tax issues or to discuss information from today's podcast. Check out the firm's website at cbh.com for the latest guidance and materials on this and other topics. This concludes today's podcast. Please like, share, and subscribe. Thank you, Cathie and Tony. As always, thank you, Sarah, and thank you, our listeners, for spending your time with us. We truly appreciate it. Let's call it a day and go forth in peace.